New data out showing that jobless claims fell again. Just another sign that the Fed has more work to do. And that notion was echoed by Philadelphia Fed President Patrick Harker today, who warned in his speech that the Fed's going to have to keep raising rates for a while, given, quote, our frankly disappointing lack of progress on curtailing inflation. Let's bring in Mark Zandi, Moody's Analytics chief economist. Mark, it's great to see you. So I guess just to start off here, from your perspective, we're all debating how much progress the Fed has made, if any, so far. What's your assessment of where we stand today and how much progress they have made?
They made progress. They had two goals. One is to keep inflation expectations down close to their inflation target. And the second is to slow the growth in the job market, get wage growth moving lower to help quell the inflation. On the inflation expectations objective, they've succeeded. If you look at 1 year, 5 year forwards, that's inflation a year from now in the subsequent 5 year period. This comes out of the bond market. These are investors putting their money where their mouth is. It's very consistent with the Fed's target of 2 to 2.5% on the consumer price index. And with regard to growth on jobs, same progress. If you go back, say, 6 months ago, average monthly job growth was about 500,000. Now it feels like it's about 300,000. Still a lot more work to be done here. We need to get down below 100K to get unemployment from stop falling and start moving a little bit north and slowing the wage growth and quelling the inflation. So still more work to be done, but I think they've made progress, some pretty good progress since the beginning of the year.
Will they need a recession to get things back to 2%?
I don't think so. I don't say that with a lot of confidence. Recession risks obviously are very high, and this is going to be very difficult. But my sense is that there is a path forward that will allow them to soft land the economy. And I do think they've laid out a script for us. The federal funds rate target, which is 3 to 3.25%, it's headed to 4.5 to 4.75 by early next year. And I think that should be sufficient given the tightening in financial conditions, the decline in the stock market, the increase in the value of the dollar, the increase in mortgage rates, the tightening in bank underwriting standards to slow the economy sufficiently to get inflation moving in the right direction. But it's a path, but it's a narrow path, and it is getting narrower as we get these inflation statistics that are definitely a disappointment.
Mark, when do you expect us to start seeing in the data that CPI, that inflation has significantly cooled? Are we talking 2 months from now, 4 months from now? I guess, what's your best prediction on that?
Yeah, I think over the next 6 months, we should see inflation, CPI inflation, let's say rounding is 8%-ish. I think by next spring, we should be 4%-ish. And that assumes the main assumption there is that oil prices stay 90, 95 bucks a barrel. Right now, they're at 85 bucks. That would be consistent with $4 for a gallon of regular unleaded. If we can manage that, if oil prices can stay roughly in that range, then the arithmetic here is in our favor because of this is all year over year, and we saw some big increases in oil energy prices a year ago. So that should bring in inflation to 8 to 4. The hard part is going to be, though, getting from 4 to 2, 2.5. That's going to be more difficult. That goes to rent growth and the cost of housing. We're getting some better news there, but that'll take a while. And the most difficult part of this will be getting the job market to slow, get wage growth moderating, because that's key to service price inflation. And that's the last mile. And that's going to take a while, probably not until early 2024.
And because of that, do you think at some point the Fed calls it a win with inflation around 4%?
Yeah. So what I think they'll do is they'll follow the script. They'll go to 4.5, 4.75 by end of January. That's the meeting in early next year. They stop. They take a look around. They know that the impact of their rate hikes will filter through the financial system and economy with a long lag. So they want to take a look around. I want to make sure job growth is slowing as I anticipate, that wage growth is rolling as I anticipate, that inflation has moderated as I just articulated and moving in the right direction. And if it is, then that's the end of the story. The 4.5% funds rate is the so-called terminal rate, the highest rate in the cycle. And they'll keep it there for a while into 2024 until it's obvious that we're headed back to target or close to. But that would be a scenario where we kind of sort of squeak our way through, avoid a recession. Although I don't want to sound too Pollyannish, under any scenario, the next year, 18 months are going to feel pretty uncomfortable. It's just a matter of how much discomfort we're going to feel.
Mark, I guess when we're also trying to figure out whether or not the risk here that the Fed is going to overshoot, I know you were saying that you expect them to pause, but what do you think the risk is, though, that they front load too much if we get a more aggressive rate hikes in the next two meetings before the end of the year? Are you concerned at all just about the spillover effect looking ahead to 2023?
Well, the risks here are two-sided. They certainly could overshoot. They may not pause as I anticipate early next year. They keep on going. And something breaks, in the financial system. The higher rates go, the faster they go, the longer they stay up. Something in the financial system is not going to work as anticipated. We got a taste of that over in the UK a couple, 3 weeks ago when the British pension funds choked on the former prime minister's plan, saw interest rates rise, and it exposed some problems in the derivatives product that they've been using to match their assets and liabilities. It's very esoteric, but that's the kind of thing that, will happen in a, highly stressed environment with interest rates at high levels for an extended period. But, there is also the other risk that they misjudge. They should continue to tighten because inflation isn't moderating sufficiently. They keep rates too low at 4.5% for too long. The inflation gets entrenched, and that's a stagflation scenario, which is pretty ugly, particularly because we will ultimately experience a recession, but just later, and it'll be more deep and severe. So there are risks on either side of that, which obviously makes this really tricky going forward. Hopefully they can kind of calibrate things and get it roughly right, but obviously a lot of risk around that.
Mark, that's something many fear might break is the housing sector, where we are seeing some Fed success, if you want to see it that way. How much pain is ahead in housing? How do you quantify it?
Yeah, well, housing's the most rate-sensitive sector of the economy, so it's not surprising it's taking it on the chin. I mean, this is by design. The Federal Reserve is raising rates to slow the economy's growth rate, the job market, to quell inflation, and so housing is going to suffer, and it really is. It's getting nailed. You saw today's existing home sales numbers. That gives you a sense of the hit to demand, and that goes to, high rates, the 30-year fixed mortgage rates over 7%. You multiply that by the house prices, and it's just unaffordable for most people. Potential first-time home buyers just can't afford that. And then, people who own their home with a mortgage, they're kind of locked in, because if they have to sell their home and get a new mortgage to buy another home at a much higher rate, that's just not going to work economically. So it does mean that house prices are going to come in. They have to come in. They are coming in pretty fast. I've been surprised at how fast they've started to fall, particularly in places like California. We're already seeing kind of 5%, 6%, 7% declines, from the peak. So we should buckle in. This is going to happen. I do expect, even with no recession, we'll probably get a double-digit kind of decline in house prices nationwide, peak to trough. I am hopeful, though, that that's not the place where anything breaks, because in the sense of what's going on in the system, because the underlying quality of the mortgages, the underwriting, the borrowers has been excellent since the financial crisis. And of course, even with these house price declines, that's after a period of very strong house price growth. So all you're doing is retracing, part of the increase that we've experienced since the pandemic hit. So I'm hopeful we will see some increase in mortgage defaults and foreclosure and distress sales, but I am hopeful that that's modest. And so I don't think that's the place where the system will break.
Moody's Chief Economist, Mark Zandi, good to see you, sir. Thank you.